Let's turn again to the tech market, but we're going to go beyond the normal AI suspects. We've talked so much about Oracle and NVIDIA, for example. We're joined by Lorne Steinberg, president of Lorne Steinberg Wealth Management. Lorne, great to see you. Thanks for coming in.
Andy, great to be back on.
Start off with Adobe, because we know it's been out of favor. People concerned that AI will hollow out its business, but you see value there?
Sure. So first of all, Andy, including Adobe's last quarterly earnings, revenues continue to climb at over a 10% clip, trading at 17 times earnings, and Adobe has incorporated AI into all of their major suite of products. And so, I mean, Adobe is a value stock with same growth potential as so many of the other software plays, and great margins, consistent earnings and free cash flow, share buybacks, truly compelling, and we see no issue with AI whatsoever.
And you see the PE pretty reasonable at 17.
17 times earnings for a double-digit revenue and earnings grower. It's on sale.
Cisco Systems, another older name, been around for decades.
And we've owned Cisco for many, many years. And interestingly enough, Andy, after years of somewhat sluggish revenue growth, Cisco's revenues are accelerating again. But this company's delivered a 13% annualized return to shareholders for the last decade. Trading at a very reasonable 17 times earnings, but earnings are growing back to the double digits again. Throw in a 2.5% dividend yield, and Cisco is just a great capital allocation story.
OpenText recently parted with its CEO. You see value here?
So OpenText is actually trading at a single-digit multiple and about 8 or 9 times free cash flow. So tons of room to buy back shares. What I really liked was the board's announcement that they're going to focus really on shareholder returns, probably divesting a couple of non-core businesses and returning to growth, but with a single-digit multiple, this is so cheap.
You think Taiwan Semi is a stock that could be held for a long time?
So we've owned Taiwan Semi for a long time, and of course it's benefiting from the AI boom. They make all the chips for NVIDIA, Apple, and a whole bunch of others. They've invested, tens of billions of dollars in plants in the U.S., and demand is those plants will be fully booked for several years to come, and so we're looking at 15% level earnings growth at roughly 20 times earnings. A great way to play that sector.
The consumer is still spending, you reckon, and you have some ideas there. Start off with Nike, if you would.
Sure. So what we like about Nike is Nike's about 1 year into its turnaround, and I just saw a report the other day where Nike's shelf space in Foot Locker and other stores, has gone from 4th to 1st. So they're focused once again on the retailers. The retailers love and need Nike. And this is a trough year for earnings for Nike, and we're looking for earnings to rise, 40 to 50% in the next fiscal year. They've got a slew of new products coming out. When you have that kind of free cash flow and you're number one in the world in footwear and sports clothing, you have the cash flow to outspend all of your competitors, and that's what they're doing. And so there's a slew of products coming out, and earnings are poised to rise once again.
Maybe if we put up the multi-year chart, as you know, Nike has fallen from its highs, and it looks as though they did miss the consumer taste for quite a while.
Oh, Nike had the last CEO was a bit of a disaster. The company stumbled, growth stalled, and the stock price fell. Now, a year into a turnaround with a new CEO, the shares are poised to rise again. Listen, it's hard to keep these great companies down. There's virtually zero debt there, huge free cash flow. As I said, they can outspend and are all of their competitors. But most importantly, they once again have gained market share in terms of square footage in all of the retailers. And we're looking for a really big, significant earnings turnaround in the next 12 months.
Let's check out Starbucks. They are apparently or have been simplifying their famously tangled menu. The poor baristas, my goodness.
Exactly. And like Nike, Starbucks is also 1 year into its turnaround. They hired their new CEO 1 year ago. And it takes time to turn around these large businesses. But I have to say we're extremely encouraged by the steps that have been taken, because they, instead of cutting costs, they've been investing in the business, adding an assistant manager to every store, simplifying the menu, I was there this morning. I have a very happy barista, welcoming me. That being said, this again is a trough year for Starbucks earnings, and next year should see a really significant bump in earnings, which should drive the share price, closer to where it used to be.
Broadly speaking, how are you positioning your portfolio? Are you more cash these days, for example? Or?
No, Andy, I have to say, and this is why we try not to think too much. If you would have told us at the beginning of the year that the U.S. would impose 50% tariffs on China, India, tariffs on every other country, my old economics textbook told me, tariffs are terrible, stock markets fall, we would have gone to cash. But because we don't like to think too much, because we never like to assume we're smart, and we are not, we just remained fully invested, and here we are today. But my real assumption is if the tariffs really impact U.S. consumers, the U.S. will reverse policy.
Lorne, thank you very much indeed.
Andy, thank you so much for having me. It's great to see you.
Lorne Steinberg.